a quick way of a recap of what we were doing in our last class. Let's have this question done and dusted. November 2016. Question number one, C. November 2016, question number 1C. If you're able to get that question, kindly mention there. Yes. November 2016, question number 1, cow business valuation. I know this is an area that at times in this case here disturbs students quite a lot. So once you get the question, are you able to say why for yes? November 2016, I can't hear you. Is there a possibility that somebody can even take a screenshot and share this with colleagues? At least one student has gotten, I want to believe that then this student can easily share that page with all the friends. So November 2016, question number 1C, we are told the following data was extracted from the financial statements of XYZ Limited for the year ended 30th September 2016. We can see total assets, we can see total liabilities, we can see preference share capital. They have given us their earnings per share, they have given us price earnings ratio, they have given us outstanding number of ordinary shares. So they want us to do something very easy. They want us, number 1, to give them book value per share. Book value per share. And then in this case here, number 2, give the market price per share. Number 3, give the market value to book value ratio. So in this sitting, ladies and gentlemen, not many students were able to get Roman 1, interpret Roman 1 very well. So Roman 1, they want us to give them book value per share. The first thing that you do there is to give us a net assets value of the business. So give us net assets value of the business. So remember that net assets value generally is total assets minus total liabilities. Total assets minus total liabilities. Now don't forget, actually for us to be always correct with this, remember that preference share capital is supposed to be part of what your total liabilities, but for us to be able to basically appreciate this forever, always ensure that you subtract, in this case here, the total preference share capital, if there is any provided, minus any, remember, if we have intangible assets like goodwill, we shall always subtract. Because when this business is being sold, for sure, that goodwill is already extinguished. By the time we're discussing about business valuation for purposes of acquiring a business, then in this case here, any intangible asset shall always be removed, minus any intangible asset, minus any intangible asset like goodwill, any intangible asset like goodwill, patents, trademarks, etc. All right. Have they gotten the question now? Have they gotten the question, all of them? Have they gotten the question, all of them? Have they been able to get the question? Please respond. Respond. I always like a class that is really lively, talking there. It's only one student who said yes. Yeah, actually a student has already shared the question here. Thank you so much. So anytime they tell you to get the book value per share, the book value is what value you're able to get from the balance sheet. Whatever value you're able to get from the balance sheet, that will be the total book value. So in this question, have they given us the total assets? Yes, they have told us that total assets are 7 million. Minus total liabilities, they've given us total liabilities of 4 million. minus total preference share capital. I can see total preference share capital of 500,000. Do we have any intangible asset in this question? Just for our future revision, mention there, 0. There is no. Yeah, NAV is net assets value. NAV is net assets value. Net assets value. Net assets value. Net assets value. NAV is net assets value. Net assets, total assets minus total liabilities. And then you remember the other small things under there. All right. So then is there somebody who is able to give me this net asset value? Total net asset value, somebody who can give me this figure? So 7 million minus 4 million, that is 3 million, minus 500,000, that must be 2.5 million. That must be 2.5 million. I suppose you guys are able to get these figures, but today, for some reason, you don't want us to really, discuss, I can see. 2.5 million. Yeah. So then once you've been able to get, so this is the total book value. It means that total value on the book of this company, total book value, which is equivalent to this NAV, is 2.5 million. And then they want us now to translate this book value per share for investors to know how much they should be able to pay for every share they buy. So therefore, book value per share. Book value per share, this will be total net assets value over number of ordinary shares, which will be 2.5 million over the number of ordinary shares that are outstanding, which have been given there as 400,000. 400,000. So then are you able to give me this answer? 2.5 million divided by 400,000. 2.5 million divided by 400,000. Are you able to give me this book value per share? Yeah, according to, thank you so much. Now we are lively now, 6.25 per share. Thank you so much. So this is what was expected of you to be able to do what here to get. I always do this. I invest in ordinary shares of these big company, listed companies, and every time I must get the company's balance sheet, I compute book value. Book value. It's very, very important for you to work with book value and what we call price earnings ratio. So on the book, the market price per share could be very different, but on the book, from whatever information they have given me, what is the book value per share? Then I compare this with the market intrinsics there. So this is really important. And then now we go to number 2 with your permission. With your permission, they've told me to calculate the market price per share. How do I get market price per share? Market price per share. So Roman 2, they want me to give them MPS. Fortunately, I can see that they have given me the PE ratio. They have given me PE ratio of 15. They have given me PE ratio of 15. Is there anybody who can remind us the formula of PE ratio? PE ratio. Is there anybody who can remind me the formula of getting PE ratio? Remember, it is P over E. P over E. It is P over E. P over E. P over E. Thank you so much. Thank you so much, Joshua. Yeah, great. So anytime they want us to give them PE ratio, my good students, PE ratio will be, this is price over earnings. So it will be MPS over EPS. MPS over EPS. So please go ahead and make MPS the subject of the formula. Make MPS the subject of the formula. If you make MPS the subject of the formula, then my MPS will be equal to this PE ratio, will be equal to this PE ratio times, I'm just cross multiplying, times EPS, times EPS, times earnings per share, times earnings per share, times earnings per share. I've only made MPS the subject of the formula. MPS the subject of the formula. So ladies and gentlemen, in this case here, then my PE ratio yeah, has been given. The PE ratio there is 15. So 15 times EPS. EPS, which has also been given. Is there somebody who is able to see the earnings per share EPS? Anybody who is able to see the EPS? Oh, yes, I can see the EPS there is 1.1. The EPS there is 1.1. So 15 times 1.1 will end up giving us what figure? 15 times 1.1. Somebody has already given me a figure. Has given me 16.5. Has given me 16.5. Has given me 16.5. Now, practically, how do we use this PE ratio? PE ratio, for those of you who would want to enter this business of buying, investing in listed companies by buying their ordinary shares, it will be very important for you to understand the PE ratio, how it works. PE ratio, how it works. Even the ones who would want to enter this space of advisory, investment advisory, you must know how PE ratio works. You see, PE ratio, like right now, in this case here, MPS, I'll be paying this amount of 16.5. So this is what I'll buy my share at, 16.5. And then this share will be earning a very small amount. The earnings per share is 1.1. This is a share I cannot buy. I'm paying 16.5 today, and then the earnings per share is 1.5. I can't buy that because PE ratio gives me number of years. It is payback period, because today I'm paying, in this case here, 16.5, and I'll be getting a payback of 1.1. So it will take me a whole 15 years to get back my money if I'm going to rely on earnings. You know, there are two ways you can earn whenever you are working with a share. If you invest in a share, you can either get earnings per share, the dividends. Now, of course, you'll get dividends from these earnings, or you make what we call capital gain, a capital appreciation. So assuming that I don't want to sell these shares in the near future, that I would want to hold these shares in the long term, that I would want, ladies and gentlemen, in this case here, to enjoy earnings for many years, if I wait, it will take me a whole 15 years. I can't buy that. I have a policy. My PE ratio is 5 times. Anything more than 5, I don't want. I don't want. Not unless, at times you'll also get some companies which have a big potential. But in this case here, for example, they are making losses, but you can see that in the near future, their earnings will start rising. For example, they have gotten a very good management. Their managers, we know, like Matt Nodor. Whenever Matt Nodor takes over a board as a chairperson, then we expect that company to have a big turnaround. So we're able to prospect like that. But ordinarily, if I average the earnings there for the last, say, 10 years, I realize they're 1.1, and then you're telling me to put in 15, to put in 16.5, I cannot. I cannot. All right. Ladies and gentlemen, from there, we move on to the next one, which is, the next one is market value to book value ratio. Market value to book value ratio. Really, this is very easy because even the formula has been given to us. Even the formula has been given to us. So remember, this is what we did in our last class. Normally, I keep on extending things because I would want, at the end of the day, you guys to love financial management. It is the best paper in CPA. Best paper in CPA. So Roman 3. So Roman 3, ladies and gentlemen, what do we have here? They want me to calculate market value to book value, to book value, to book value. So then this will be MPS over book value per share. Book value per share. So the market price per share, already I'm able to see that. The market price per share, I've computed it here. It is 16.5. All over the book value, which we got somewhere up there, which was 6.25. So the book value, the market value to book value ratio. So is there somebody who is able to give me this figure? So according to Mercy, my friend here, 2.64. 2.64. So have you understood now this question very well? Have you guys given this highlight? Have we been able to understand this, get deeper understanding of this question? Have you been able to understand now this question better? Great. So please ensure that you ride on it because it comes often. It comes often. Now, again, the other area that I would want us to revisit, is this area of valuing ordinary shares. This area of valuing ordinary shares. So whenever they tell you to value ordinary shares, my good students, valuation of ordinary shares, I do this all the time because I don't want to invest anyhowly. I don't want to get people buying shares anyhowly. That is not me. Valuation of ordinary shares, Yeah. So in this case, of course, this is intrinsic value. Intrinsic value. Yeah. What we call PO. How do we get this PO? It's very easy. It is the present value of my future earnings. Present value of future earnings. Present value of future earnings. So if I know I will be getting this much from my shares, then I discount them. Then that one will be able to give me the value that I'm willing to pay. Because there is no way you'll be able to tell me that, hey, if you invest in these shares, you'll be getting 1 bob, 1 bob, 1 bob. I discount all that, I get 10 bob. Yeah, and then you tell me to put in 50 today, then I'm crazy. I'm an investor and I would want to make some money out of this investment. All right? So maybe somebody can help me answer this, Ninja. I think they can leave like half a page space. All right. So in this case, you want to get present value, or rather PO is the present value of future earnings. And remember that our future earnings are dividends. So it is present value of dividends here. Present value of dividends. Now remember, we are making an assumption for shares that once we buy these shares, we shall stay with them forever. Whenever you buy shares, you shall stay with them forever. Now let me ask you a question. Assuming in this case here, we have Vera here. Yeah. If Vera in this case here was to get somebody who tells Vera, it could be a company she has invested in, that she will be getting 10 million per annum every year. Then she asks this company that I've invested in for how many years? This person says infinity. There is no end in sight. And then R happens to be 5%. Could you kindly give me present value of Vera's cash flow? Present value when N is infinity. Present value when N is infinity. We have only done one question, I think half a page. Tonditi will do you good. Yeah, so in this case here, present value, whenever we have an annuity, yeah, without an end in sight, where N is infinity. Anybody who is able to assist here? Thank you so much. What have they done? That when N is infinity, then, ladies and gentlemen, we'll take the annuity amount, we divide by R. And therefore, this amount, in this case here, is 10 million. We divide by R, which is 0.05, like that. That is how these people were able to get 200. So it doesn't stop there. We have, in this case here, the same company giving very good news to Vera. It was telling Vera now, it won't be 10 million every year. We are a nice company. We shall ensure that there is a growth rate. What if in this case here growth rate is provided? What if growth rate is provided? So for example, if Vera's cash flow will grow by say 1%, 1% per annum. So if Vera's cash flow will grow by 1% per annum, then her present value will be the amount into 1 plus growth rate. This one, so 1 plus growth rate, all over R minus G. All over R minus G. So if there is a growth rate, ladies and gentlemen, this is how we shall be handling growth rate scenario. So then the amount here is 200 million. No, amount is 10 million. Amount is 10 million into 1 plus growth rate. And the growth rate is 0.01. All over our R, which is the required return. required return or cost of capital is 5%. 0.01 minus the growth rate. No, 0.05 minus 0.01. So here you have to be very careful. You will say 10 million times 1.01. 10 million times 1.01 equals. And then you divide this by open brackets, whatever you get there, I repeat, 10 million times 1.01, you divide by open brackets, 0.05 minus 0.01, you close the brackets. Then how much are we able to get, ladies and gentlemen, in a situation where we have an infinite with a growth rate? With a growth rate. So 10 million times 1.01 over 0.04. I'm waiting to hear from you. Yeah, should get much higher. Should get much higher. Should get much higher. Really, should end up getting 275. Can somebody else confirm that 275 amount? Can someone else confirm that 275 amount? $252.5. Somebody has said no. 252.5, yeah. How do you get it? It's very easy. Ensure that you are using your brackets very well. So you say 10 times 1.01, because brackets first, divided by open brackets. Yeah, open brackets, 0.05 minus 0.01. Remember, the denominator must always be kept in its own what here? Brackets. Denominator must always be kept in its own brackets. I'm being told no. It is supposed to be 252.5, and I'm happy to see that it is all of you who have gotten this. Now, ladies and gentlemen, now listen and listen to me very well. This formula is what forms the basis for us all in terms of what here? In terms of finance. This formula is very, very important. We shall use this formula to value so many things. So, for example, when they tell us to value a share, yeah, present value of future dividends. So in this case here, we shall say for ordinary shares, ladies and gentlemen, our PO will be equal to DO into 1 plus G. Yeah, the same. Because now we are talking over the ordinary dividends. All over what, ladies and gentlemen? All over KE because of cost of equity. Remember, a share is an equity instrument. So this is the return. All over cost of equity minus our growth rate. All over cost of equity minus our growth rate, So can somebody in this case here, I hope you are able to see how we've been able, here you can use either R or KE, but because ordinary share is an equity instrument, we prefer using KE here. So are you able to remember that we did this in our last week's classes? Are you able to remember that we valued shares in our last week classes? Are you able to remember we valued shares in our last week classes? Are they able to remember that? Yeah, great. So then we shall be able to do just one reminder question before we go to bonds. And I would want us to do this old question of Yeah, let's do two questions. Let's start with qn3a. We go to November 2017, question number 3A. Just as a quick reminder, I always like reminding my students, doing this question severally. After all, I mean, we need to do just revision. This is a special revision class. This is a special revision class. So November 2017, question number 3A. 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 Yeah, no worries. Don't worry about that. I'll be able to take care of that. So November 2017, question number 3A. Question number 3A. November 2017, question number 3A. November 2017, question number 3A. Let me know once you great students of mine are able to get that question. Once you get the question, then we shall be able to tackle it pretty first. November 2017, question number 3A. So November 2017, question number 3A, are we there? November 2017, question number 3A. Yeah, thanks for asking that question. Yes. So we are told here the ordinary shares of qn3a Limited are currently selling at 60 each at the Securities Exchange. The company's PE ratio is 6. qn3a Limited adopts a 40% payout ratio as its dividends policy. It is predicted that the company's earnings and dividends will grow at an annual rate of 10% for the first 3 years, 5% for the next 2 years, and 4% thereafter in perpetuity. The investors' minimum required return is 12%, so they want us to give them the PO. I'm a good student of finance, very good student of finance. Whenever I see them giving me PE ratio, there must be something they have hidden from me. So whenever I see them giving me PE ratio, yeah, I'll apply the formula. So it is MPS over EPS. We agreed about this. There must be something these ninjas are hiding from me. So the company's PE ratio is 6 times, which will be equal to the MPS. The current market price per share, are you able to see the MPS? Is there somebody who is able to see the MPS, ladies and gentlemen? Anybody who is able to see the MPS, ladies and gentlemen? The company's market price per share currently 3A. Yeah, question number 3A. Currently, anybody who is able to see the company's market price per share? 60, Bobby, yeah. Because you're told the ordinary shares of qn3a Limited are currently selling for 60. So they must have hidden something from me. And I know this must be earnings per share that they haven't given me. So can you kindly go ahead and give me the EPS? Make EPS the subject of the formula. So this will be 6 times EPS equals 60. Therefore, EPS will be 60 divided by 6, which gives me 10. We don't use EPS to value ordinary shares. So I'm so sure out of this EPS, the examiner will give me what we call payout ratio. The examiner will give me the payout ratio. It is out of the payout ratio that I'll be able to get dividends per share. So use payout ratio to ascertain DPS from EPS. So has this examiner given me the payout ratio? Yeah, qn3a Limited adopts a 40% payout ratio as its dividends policy. And therefore, DPS will be equal to EPS times what is being paid out, times payout ratio, So it will be, ladies and gentlemen, EPS is 10 here, times payout ratio, which they have told me is 40%. That is how a good student is able to arrive at 4. So, ladies and gentlemen, up to there, are we okay? Up to here, are we really okay? Because when you see the examiner giving you PE ratio, there must be a parameter is denying you. There must be a parameter is denying you. Yeah, I want to get your response so that I can know how to play the ball. Yeah, somebody should be able to share the question. Yeah, in the group. Please share the question in the group. Please share the question in the group. You can even give them access to all of them. Yeah, thank you, Daniel. You must be a very good gentleman. So now after that, what do they want me to do? They want me to give them the intrinsic value, the one of discounting dividends. And then I can see in paragraph 3, it is predicted that the company's earnings and dividends will grow at an annual rate of 10% for the first 3 years. So we have year 1, 2, 3. Yeah. And then in this case, here 5% for the next 2 years. Next 2 years is 4, 5. And then thereafter, 4% infinitely. So the first 3 years, 10% growth rate. The next 2 years, ladies and gentlemen, we have 5% growth rate. Yeah. And then, of course, in infinity, we can see we have what we call growth rate of 4% per annum. So this is my time. So then I should be able to give them expected. Remember, we use what we call expected dividends. I don't use historical. I don't use DO. To value my share, I'll always use future dividends. So currently, I can see the dividend here is 4. So then this will be very easy. So for the first 3 years, we are growing at 10%. So remember, this is about the dividend into 1 plus G. So we have here 4. Let this 4 grow by 0.1. Let it grow by 0.1. So then at the end of the first year, we shall receive how much? At the end of the first year, we shall receive how much? I can see we are 30-something, and I'm 100% assured that most of our classmates in our normal classes are not aware of this particular class, which happens on Saturday and Sunday, that RCM has been able to offer to you purposely for revision. So 2 things. Either they are not aware of this class, or if they are aware, they are not aware of how financial management can harass students. Is there anybody who did the FM here for last semester? If you did the FM for last semester, you will be able to bear witness with us that any student who was not a member of this special revision class was really harassed. Not that you have bad teachers, you have excellent teachers, but you see now those teachers, first of all, they have to cover the syllabus in the normal class. And the syllabus is huge. That is why students who know about this class, they don't miss. And we are not competing as teachers, no. We are simply coming to give you here on Saturdays and Sundays an opportunity to see questions clearer. Yeah, I was harassed, you can see. The paper can really be harassing. This is not a joke. But once you attend these kind of sessions and then you have attended the sessions, of course, at RCM, we have about 4 financial management classes. Here you have different teachers here, and then you come to simply revise here with Mzee. You will like this paper so much. And don't, in this case here, procrastinate a lot. Don't come to me when it is only 1 month the exam or 2 weeks the exam. We should be meeting you on Saturdays and Sundays. Saturdays at 8 a.m. and then Sunday at what time? Sunday at what time? Somebody who is able to know our timetable? Sunday at 2 p.m. So please pass that information, because nobody should be harassed by this paper. Nobody. It's an easy paper. So we have here 4.4. From there, we come to year 2. Year 2, we expect this again to grow by 10%. So 4.4 into 1 plus the 0.1. How much are we getting there? How much are we getting here? Somebody is already getting 4.84. So 4.84. From there again, we have this 4.84 growing by that 1.1, because 10% is constant for those 3 years. 4.84 times 1.1, that will end up giving us 5.324. So we have here 5.324. So we pick it from here. So this will be 5.324 into 1.05. Now we have gone to 5%. So 5% growing, 5% growth on top of this. So times 1.05. We can restrict our numbers to 3 decimal places. Let's restrict our numbers to 3 decimal places. Yeah, so this gives us 5.590. And then now we have here 5.590 into 1.05, which will end up giving us a what figure? Which will end up giving us a what figure? 3 decimal places, if you don't mind. 3 decimal places. Is it 5.870? 3 decimal places, Daniel. For accuracy purposes, the more the decimal places, the better. 586. Yeah, so 5.870. 5.870. Thank you so much. So all of us, are we in agreement about these numbers? All of us, are we in agreement about those numbers? All of us are in agreement. Thank you so much. Now from there, we go to the infinite. We go to the infinite. We go to the infinite. Let's go to the infinite. Infinite, remember infinite is what we normally call the Gachagua model. Whenever you see infinity, we always remember Gashagua's model because Gachagua is the one who kept on telling us shares, dividends, etc. So, and remember Gashagua's model, ladies and gentlemen, we normally say PO. He used to be a district officer who grew in ranks. Yeah, and after he left government, of course, the government is trying, but it's like now we have, our country without a government. Because the cost of fighting this man is too high. The cost of fighting. So in this case, anytime you hear about infinite, these people will continue fighting this man indefinitely. He may not go anywhere, but he's a thorn in their flesh. So district officer who grew in ranks, Gachagua, all over Kenya without government. So this is not Kenya, but this is what here, cost of equity. Cost of equity. Cost of equity, G is the growth rate. So we normally use these to value infinity. To value infinity. We normally use this to value infinity. So growth rate of dividends. Growth rate of dividends. 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 So in this question, have they given me the cost of equity? Oh, yes. They've given me the minimum required rate of return as 0.12, 12%. So now remember, I'm using this formula to value my infinity cash flow. How do I do it? Remember now my DO, the most recent is this one here. So it will be 5.870 into 1 plus the infinity growth rate. So 0.04, yeah. All over, in this case here, cost of equity. Cost of equity is 0.12 minus the infinity growth rate, 0.04. That's how we value the infinity cash flow. I've always seen students separating. They'll say that where we have in this case here, non-constant growth rates and a constant growth rate. Trust you me, that method, that's a method I used to use in those old days. This is what now we have. This is the very best method. You simply handle everything together. So long as you remember very well that we are calling this one infinity, the Gashagua's model. The Gashagua's model. I like what Queen is giving me there, 76.31. 76.31. 76.31. From there, ladies and gentlemen, we want to discount these. So give me PVIF at the R. Give me PVIF, present value interest factor, at this cost of equity or at this cost of capital or at this required return, 12%. So do we have in this case here financial discounting tables? Do we have our financial discounting tables? And if yes, then are we able to, if yes, are we able to use it very well? PVIF at 12%. PVIF at 12%. How I wish somebody had this table, and then we get to use it very well, very fast. But if you don't have it, no problem. I know the formula of getting PVIF. I know that PVIF is 1 plus R raised to negative n. So R, I know it's 12%. So it will be 1 plus 0.12 raised to negative n. So it will be 1.12 raised to negative n like that. So the first one will be 1.12 raised to minus 1. So 1.12 raised to minus 1. What figure are we able to get, my good students, please? Yeah, we have a Tina giving me 0.8929. 0.8929. Thank you very much. So then go to the second year, raise it to -2. Raise it to -2. -2. Thanks, Daniel. How I wish I would be getting these answers from every student. Yeah, thank you so much. Somebody has actually given them all to me. 0.7972, 0.7972, 0.7972. Then I have 0.7118, 0.7118. Yeah, and then we have, ladies and gentlemen, 0.6355, 0.6355. And then we have lastly for year 5. So for year 5, 0.5674, 0.5674, 74. And then remember, for the last one, you can't say 1.12 raised to negative infinity. The last one, in this case here, remember, we borrow this. This is what we drop down here. This is what we drop down there. And then now we'll be able to come and give us the discounted cash flows. 2 decimal places will be sufficient. They suffice. 2 decimal places. Yeah, drop down. Thank you very much, Daniel. You drop down that figure. You drop down this figure. You simply drop it down for the infinity. You simply drop this down. So discounted cash flows. So we are taking this 4.4 times 0.8929. What figure are we able to get, my good students? 2 decimal places for discounted cash flows. So the first one, I'm being given 3.93. Thank you so much. For discounted cash flows, 2 decimal places are good enough. 3.93. 4.84 times 0.7972. 3.86. Thank you so much. 3.86. Thank you so much. Then we go to 5.324 times 0.7118. Mm-hmm. 3.79. Thank you so much. 3.79. And then we have here 5.590 times 0.6355. Yeah. So in this particular case, ladies and gentlemen, it is 3.55. 3.55. Second last. 3.33. Yeah. And then our lastly, we have 76.31 times 0.567074. Thank you. So 43.30. 43.30. So we have here 43.30. So please come and give me the total intrinsic value. The total intrinsic value, you now add all of those discounted cash flows. You add them. Total intrinsic value, we add all of them. Add all of them. $61.76. So this is the truthful value. This is the intrinsic value. The intrinsic value. This is our PO. Our PO. From there, you go straight away and they give us the alpha value. The alpha value. The alpha value. So you go straight away and they give us the alpha value. So give us the profitability index. Profitability index, which is the same as alpha value. So the alpha value, we normally take the intrinsic value minus the current MPS. The intrinsic value minus the current MPS. Intrinsic value minus the current market price per share. So the intrinsic value is 61.76 minus the current market price per share Are you able to see the current market price per share? Currently, this is selling for how much? Currently, it is selling for 60 bob. We are told currently the share is selling for 60 bob. For 60 bob. Are you able to see the, thank you so much. So 61.76 minus 60, this gives me 1.76. So even if it is a penny, doesn't matter, so long as it's positive. Yeah, so this is profitable. The share is profitable. And if it's profitable, we say it is super efficient. We say it is super efficient or undervalued. Undervalued by market forces. Undervalued by market forces. And therefore, the investor should buy. The investor should buy. The investor should buy. Yeah. And basically here, I'm answering Roman 2, which wanted me to advise the investor. They wanted me to advise the investor. I'll always advise my investors on the basis of profitability indices, what we call the Jensen's alpha values. Jensen's alpha values. So profitability index there. Yeah. If, for example, you got like a negative answer, then that would have been inefficient. That would have been inefficient. If it's a loss, it's an inefficient. And if it's inefficient, we say the share is overvalued. You see, something that is overvalued is a bad thing. Even you, for example, assuming we have a lady who is or a man who is married here. Yeah, and then you are getting out of your house, you're trying to please this great lady here, and then she tells you, you are overvaluing yourself for nothing. You're overvaluing. So if she tells you you're overvaluing yourself, it means that you are good for nothing. You are just a loss-making entity. All right? So the same case with shares. When you get a share with a negative alpha value, right, then that is or rather it's an overvalued. It's good for nothing. It's overvalued. So is that concept home? Is that concept home? Is that concept home? Please don't use that. Remember that is just theory here. Don't use that against your spouses. Never ever use that against our spouses, and we shall never fight our spouses. Always, as an accountant, wherever you're working, even at home, we must always ensure that we know how to handle our anger issues. We should not be those people who are quick to anger. Always. We shall always be very, very polite. Anger issues, no. Because anger issues are the ones in these cases that take people to prison. If you look at people who are in prison today who committed some felony here, 99.99% is because they never knew how to be emotionally intelligent over situations. Yeah, you must know how to handle this. Very, very important. So, ladies and gentlemen, can we go to our next concept? Now I've been able to at least tackle this. So now our next concept, which I would want us to handle, very, very importantly, I think I should be able to introduce this after our short break. It's important we take a short break, isn't it? It's important we take a short break. Over how many minutes? Of 10 minutes. So during short break, it will be very, very important that you get to bring all your classmates. Yeah, remember, even if they are working, they can easily plug in something on their ears and then they get to listen. Because here, you'll be able to get much more insights. Because I'm not under any pressure to finish anybody's syllabus here, because I'll finish it. Mine is just questions and answers. I'll finish. I'll actually be ahead of every teacher, despite the fact that I started late. Yeah, because of what, it's special revision. I'm teaching students who have been in someone else's class. Now they're coming to my class for revision. Let them know that they are missing. And we are complementing what the other teachers are teaching. So great. And of course, if there are students in this case here who would want to join RCM, the very best college in East Africa, we say that with our shoulders high because that is the truth. Yeah, please join us today. That's our number, 0793 555 000. So we take a break of 10 minutes. Yes, no problem, yeah. No problem. Great. 0793 555 000. Okay. Yes, dividend valuation model is Gordon's model. Yeah. Dividend valuation model, we call it DVM, is Gordon's model. So you're taking 10 minutes, so shall come back at exactly 9:10, 9:11 actually. So valuation of bonds. Bonds. So valuation of bonds. So for valuation of bonds, what you're supposed to know, ladies and gentlemen, is that we have two types of bonds. Actually, three. Yeah, three types. So these three types. So number one, we have what we call irredeemable bond. Number two, we have what we call redeemable bond. Yeah. And then number three, ladies and gentlemen, we have what we call convertible bond. The one that will be able to convert to ordinary shares. The one will be able to convert to ordinary shares. All right. So these are really, really very good. Remember, redeemable, N is infinity, eh? N is infinity. N is infinity, like that. N is infinity. N is infinity. N is infinity. Okay, and we shall straight away look at little examples here. So we have here, Mr. A has invested in a bond whose par value is 100. Full stop, Kenya shillings. Yeah, the coupon rate is 8%. The coupon rate is 8%. Yeah, 8%. And the required return the required return is, yes, the required return is 10%. Please give me the value of this bond. Value of the bond. Are you able to get the value of the bond there? Please give me the value of the bond. The value of the bond. Give me the value of the bond. Yep, value of the bond. Give me the value of the bond. Can I give you 1 minute to try that? Loud, okay. So Mr. A has invested in a bond whose par value is 100. Yeah. And the coupon rate, yeah, is 8%. And then they want you to give them the value of the bond. They want you to ascertain the value of the bond, value of the bond. So I'm giving you exactly 3 minutes. I see whether you'll be able to get this right. Anybody who is able to get this right? Anybody who is able to get this right? So remember here, they have not given us N So there is nothing like redemption. They haven't given us n. So ladies and gentlemen, they haven't given us n here totally. So therefore, we are dealing with an irredeemable bond. And if we are dealing with an irredeemable bond, then what are we looking at here, my great students? If we are dealing with an irredeemable bond, yeah, so we know that irredeemable bond, yeah, I will look at the present value of my investment. The investment that I've put in is a bond I've bought. And from this bond, I'll be getting interest. So basically, I will take, remember if it's a redeemable bond, value. You'll simply look at the interest receivable, interest received per annum, and because it's going to be in perpetuity, you divide this by what year? You divide this by R. You divide this by R. Yeah, so in this particular case, ladies and gentlemen, then the interest here for this question, the interest automatically will be the coupon rate. The coupon rate is 8% times, what do we have here? The par value. So interest is coupon rate times the par value. Par value is 100. So 8% times 100, this gives me 8. So I'll be enjoying this 8 forever. And because I'll be enjoying this 8 forever, then this one here will be 8 divided by the required return, the investor's required return. The investor in this case here requires a 10%. The investor requires a 10% return. So you come and divide this by point what year? You divide this by 0.1. You divide this by 0.1. So 8 divided by 0.1 will end up giving me how much, ladies and gentlemen, here? 80 bob. 80 bob. So n has not been provided. So 8 divided by 0.1, that gives me 80 bob. That gives me 80 bob like that. That is the current value of this irredeemable bond. How have I known it's irredeemable? Because the examiner has not given me the number of years. The examiner has not given me the number of years. The examiner has not given me the number of years. Great. How about if we have a redeemable bond? If we have a redeemable bond, what will happen? So for redeemable bond, for redeemable bond. So for redeemable bond, ladies and gentlemen, I would want us straight away to know that the value of a bond will be equal to present value of interest. Present value of interest, present value of interest. Yeah, this will be very, very important. You value them. Yeah, and of course, as you shall see, there are annuities. Yeah, because you're going to get this every year. And then in this case here, plus present value of redemption value. Redemption value. Present value of this redemption value. Present value of the redemption amount. Call it redemption amount to avoid redemption value. Redemption amount. Redemption amount. So then I would want us to look at a past paper question, my good students, from your revision kit. And please buy RCM's revision kits. It will be very important for you to buy RCM's revision kits always. You cannot go wrong with them. I would want us to do April 2024, question number 2, boy. April 2024, question number 2, boy. So April 2024, question number 2, boy. So once you get this question, kindly mention there yes. Mention there yes. April 2024, question number 4, boy. At least Tina has gotten it. I would want to hear that from many students. Yeah, at least now we have 2 students, so everybody's okay there. So Sophia Wambia intends to invest in shillings 2 million to invest is 2 million in a 12% debenture for 3 years. For 3 years. The current market value of the debenture is 80. Yeah. The required rate of return on the debenture is 10%, and the par value is 100. Is 100. So, ladies and gentlemen, then I can straight away see that this is a debenture which has got what year? A redemption period. So then, first of all, I would want you to give me the interests to be earned. Interest per annum. So this will always be equal to the coupon times, in this case here, the par value. Coupon times par value. The coupon that we are able to see, the coupon rate of interest, which will be earned, is 12%. 12%. Who is able to see the par value there? The par value, ladies and gentlemen, is 100. So is there somebody who is able to give me this interest per annum? So interest per annum, I've just joined. Remember, we are doing a business valuation and a securities valuation. So in this case here, every year, this ninja will get 12. Will get 12 every year. And therefore, when we talk of the value of the bond instrument, it will be equal to the 12 that I'll be getting every year times PV-FAR. 12 times PV-FAR. Have they given me cost of capital? Have they given me required return? Have they given me required return in this question? Have they given me the required return? Is there somebody who is able to see the required return of the debenture? Required return of the debenture. Unfortunately, it's only very few students who are responding, but we shall overcome. It's 10%, isn't it? 10%. And then remember that I'm going to enjoy these 12 for 1, 2, 3 years. 12 for 1, 2, 3 years. So in this case here, 12, these are 3-year bond. So in this case here, for 3 years. After 3 years, if it's a bond, your money must be returned back. Your money will be returned back. But they haven't given me the redemption value. So when they don't give us the redemption value, how much I'll be receiving back, how much should I work with in this case? Yeah, how much should I, in this case here, how much? Help us understand the question. I think that's what I'm doing, Hassan. Or what am I doing, Hassan? Or do you want us to read? Because I've already given you the formula here, that this person will be getting interest every year. So 12% at 100, 12. So in this case, ladies and gentlemen, how much will be the redemption value? How much will be the redemption value? Which topic? It's called business valuation, security valuation. Topic number 4 is topic number 5, around there. So yeah, so we shall make an assumption that we are going to redeem the bond at par value. So in this case here, the redemption period is 3 years. And at the end of the 3 years, we shall be able to get back this money, the whole of it. So in this case here, plus 100. And because this 100 is going to be received only once, because it's going to be received only once, I will discount it using PVIF. I will discount this using PVIF. So times PVIF, yeah, 10%, 3 years, PVIF. Because I'm going to get this at the end of the 3rd year, only once. It's a lump sum amount. So remember, once I invest in this bond, ladies and gentlemen, this is what is going to happen. Once I invest in this bond, I will get 12, 12, 12 as interest. And then at the end of the 3rd year, I will come and again get what here? 100 back, by cash back 100. What I've invested in. All right. So I'll be getting interest of 12. So these are annuities. I'll be enjoying this interest for every year. Every year. So, ladies and gentlemen, I'm so sure you guys have tables. Is there somebody who is able to give me this PV for 10%, 3 years? PV for 10%, 3 years? PV for 10%, 3 years. Anybody who could be having it? PV for 10%, 3 years. From your annuity table. From your annuity table. From your annuity table. Anybody who could be having this? From your annuity table. So from the annuity table, they're giving me 2.4869. So we have here 2.4869 plus 100. How about the PV factor 10%, 3 years. Now from the other table, not annuity. Yeah, so we have here 100 times PVIF, 10%, 3 years. PVIF, 75 something. Yeah, 7513. 7513. 7513. Yeah, 7513. 7513. Then the value of the bond will be equal to who? What will be this value of the bond be equal to? So at times they will tell you the redemption value. At times they will tell you the redemption value, and there are times they won't tell you the redemption value. So how much are they getting somebody there as the value of the bond? 104.97. So they're getting value of the bond as 104.97. 104.97. So 104.97. 104.97. And remember, if this lady buys this today, she'll buy the bond for 80 bob, because the current market price per share has been given as 80. So get ahead and calculate our profitability index. Calculate our profitability index. Index, what we call the alpha value, which will be the intrinsic value, the one you've used the formula. Intrinsic value minus market value, minus market value, market value. So the intrinsic value is 104.97 minus the market value of the bond, which happens to be 80. Market value of the bond, which happens to be 80. So it means that for every bond she buys, she'll be getting 24.97. For every bond she buys, she'll be getting a profit of 24.97. So this is profitable. This is profitable, 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 meaning that the security is super efficient. The security is super efficient, or the market is undervaluing it. Super efficient securities are always under what year? They are always undervalued. They are always undervalued. Just like a vehicle, you can get a vehicle that is undervalued, you buy it, and then you go to the market and sell it the same day. You make what we call an arbitrage profit. You make what we call an arbitrage profit, where you take advantage of price differentials to be able to make a profit. So long as they tell you that this bond is going to be refunded, the bond value will be refunded, this is the approach we shall always be taking. This is the approach I shall always be taking. Great. So can I now go to a different question? So in short, if it's super efficient, if it's undervalued, the advice to this great lady is that she should be able to invest in the bond. Let her invest in the bond. Yeah, redemption amount, yes. You see, this redemption amount, some questions like the one you're going to do, you will see the examiner telling you that at the end of the maturity period, the investor will get back like 10% more of the par value. So in that case, she would have gotten back 110. Or she will get 10% less of the par value. She gets back 90. But in this case, the examiner is silent. When the examiner is silent and they have told you that this bond has a maturity period, then you will make an assumption that you will be refunded back the par value. And the par value here happens to be what year? Happens to be 100. The par value happens to be 100. Whenever the examiner is silent about how much you shall receive back, we shall always receive back. We shall redeem the bond at par. We shall redeem the bond at par. Yeah, the most important question, or rather concept here, is that we are valuing these securities on the basis of our income. Which incomes do we have? In this case here, there are two of them here for the bond. I'll be getting interests every year, and then at the end of the third year, I'll be getting 100. I'll be getting 100. So the 12 is an annuity. It's a repetitive figure, so I'll be able to discount it using PVFAR. And then the 100 is one-off figure. I'll be getting it using 100. I'll be getting it, discounting it, using what we call PVIF. So please go and watch this video again. This seems to be a bit difficult for you, but it's quite easy. Watch this video again. So can I go to the next question, ladies and gentlemen? Can I go to the next question? Still under these bonds, still under bond valuation. Can I go to the next question? Can I go to the next question? All right. All right. So this next question, ladies and gentlemen, is one that is convertible. One that is convertible. One that is convertible. One that is convertible. Convertible bond. Where do I get this one that is convertible now? Yeah, before you go to a convertible bond, I don't know whether these students can do an abracadabra and get this May 2014 question. I have a question that is very, very good that I would want us to do here. Yeah, May 2014, question number 2, boy. May 2014, question number 2, boy. You can actually write the question. You can actually write the question down. You can actually write the question down. May 2014, question number 2, boy. Question number 2, boy. So we are told here Summit Limited issued a new bond 5 years ago. Issued a new bond 5 years ago. 5 years ago. The bond was sold at par. The bond was sold at par. The bond was sold at par, shillings 1,000. Shillings 1,000. And has a coupon rate. And has a coupon rate. Has a coupon rate of 12%. And a maturity period of 30 years. And maturity period of 30 years. Maturity period of 30 years. Coupon payments are made semi-annually. Coupon periods are made semi-annually. Full stop. The interest rate has currently gone down to 10%. The interest rate has currently gone down to 10%, to 10%, to 10%. So required 3 of them. Very important questions here. The current price of the bond, that's number 1. Current price of the bond. Current price of the bond. Number 2, current yield to maturity. Current yield to maturity. And then number 3, lastly, they want me to give them the capital gain on the bond. The capital gain on the bond. The capital gain on the bond, this is the same as alpha value. Alpha value. Never confuse that. So I want to give you exactly 3 minutes. Try looking at this question, especially Roman 1. Especially Roman 1. Roman 1. Current price of the bond. I'll give you exactly 3 minutes. Yeah, if available somebody, we don't have 2014, no problem. Great. Now I've been able to copy it down. I believe now it's okay now. So Summit Limited issued a new bond 5 years ago. The bond was sold at par, shillings 100, and has a coupon rate of 12%. 12%. Maturity period is 30 years. Coupon periods are made semi-annually. The interest rate has gone down to 10%. So they want us to give them the current price of the bond. This question I was marking this semester, there are very, very few students who got this question right. Very few. And yet it is really easy. So I'm giving you exactly 3 minutes. Par value is 1,000. Eh? The par value is 1,000. Yes, I don't know, maybe I wrote it wrongly. Yeah, the par value is 1,000. Yeah, you're right. The par value is 1,000. You're right. So let me give you 3 minutes, and then you try it. And then once I knock it down 1 minute, the question will be down, and everybody will be happy. Our par value is 1,000. So let me know once you're ready for me to do the question. I'll be able to take it head on. Once you have been able to scratch your head a little bit, I'll show always in financial management, you're scratching your head. Eh? We shall always scratch our head a little bit. And then our Mwalimu dives in. All ears waiting to be told by yourselves, Mwalimu now. We have tried and we are unable to make a move. Or this is our suggested answer for the bond value. All right. So ladies and gentlemen, can I go ahead and do it? Current market price, thanks for trying. Surrendered, thank you very much. It's good always to surrender, but after you've tried, thank you, Queen. At least somebody has tried it. So in this question, what is our N? Can somebody tell me in this question, what is our N? A number of years, number of years. That is where so many students confused. 25, thank you so much, 25. 25. Because you see the bond itself is a 30-year bond, and it was issued 5 years ago. It was issued 5 years ago. So already 5 years have lapsed. Remember, for us, we look at expected future earnings. So you only have 25 years. And it's 25 years. Interest paying periods. Interest paying periods. Interest paying periods. Remember, this bond is going to be paying us semi-annually. Semi-annually. We said whenever you hear the word semi, you must always come and double this. So in this case, it will be n times 2. Yeah, this becomes what here? 25 times 2. This becomes 50, like that. So those are the interest paying periods. Because every year, we shall be receiving interest twice. Remember, ladies and gentlemen, what we discussed here. We said, like in this case here, our R is 12% coupon rate. Our coupon rate is 12% per annum. So we said, in this case here, because it is semi-annual, then our interest rate will be 12% over 2, our semi-annual interest rate. So we say the R you divided by 2, but N you increase by multiplying by 2. If you remember very well, the rate, you divide the rate by 2, and then, ladies and gentlemen, the number of years, you always multiply them by 2 in semi-annual. If it was a quarterly, then we would have done divided by 4, multiplied by 4. So then in this case here, semi-annual coupon rate, in this case here, this is 0.06. It's 6%, like that. And therefore, interest in Kenya shillings, it will be interest. You take the coupon times the par value. Coupon times the par value. The coupon never changes. The other mistake we saw in this year, so many people are using that reduced rate of 10%. No, even if the rate goes down, the bond has a fixed return. The bond has a fixed return. The bond has a fixed return. So in that case here, then the coupon is 6% because it's every 6 months times the par value over 1,000. Par value over 1,000. 6% times par value over 1,000, which will end up giving me how much, ladies and gentlemen? Which will end up giving me how much, ladies and gentlemen? Remember, interest, this is a fixed return security. So the coupon interest never changes. That cannot change. The required return can change, but the coupon never changes. 60 per annum. 60 per annum. 60 every 6 months. 60 every 6 months. 60 every 6 months, actually. And then I'll go and give me this current price of the bond. Give me the current price of the bond. Current price of the bond. So the current price of the bond which is also known as intrinsic value, will be equal to present value of this 60, of the 60, plus present value of redemption amount, because this is a redeemable bond. Present value of redemption amount. Present value of the 60 plus present value of redemption amount. After now those 25 years are over, how much shall we be able to get back for us to surrender the bond? Because bonded, you are bonded. Yeah, it's a contract. So for us to surrender the bond, how much shall we receive back? What is the redemption value in this question? What is the redemption value in this question? Redemption value in this question is par value, because they haven't told us that they are going to redeem the bond at a different amount. They haven't told us that. So in this case here, you're right, that redemption amount is par value. Redemption amount equals par value. equals par value, in this case here, which will be 1,000 bob, which will be 1,000 bob. Very good. So then in this case here, what is the required return? The investors required return. The investors required return of investors. So the investors, of course, they will always go by the current rate. So you can see in this case here, the rate has gone down to 10%. The rate has now gone down to 10%. But now remember, this is per annum. Per annum. For 6 months, semi-annual. For 6 months, for semi-annual, we shall use 5%. 5%. The 10%, ladies and gentlemen, is annual. The 10% is annual. A whole year. So remember, the required return of these investors is the discounting factor. So remember, this is a discounting factor. Remember, this is what you shall use as discounting factor, as the cost of capital. So let's get back to this. Let's get back to this. So then what do we have, ladies and gentlemen, here for this redeemable bond? So for the redeemable bond, this is what we shall do. To be able to get the intrinsic value, we shall take our 60. But 60 is PVFA. It's a regular amount. It's a regular amount. And we are discounting this at 5%. Yeah. For how many periods? You guys gave me 50 periods. 50 periods. Plus the redemption amount. We are going to redeem 1,000. 1,000 is lump sum, only receivable ones. So times PVF, 5%, 50 years, 50 periods. Even if we call them years, no problem. No problem, 50. So then we need PVF. So PVF, remember the formula of PVF, present value interest factor. It is 1 plus R raised to negative N. So PVF, ladies and gentlemen, 5%, 50, this one here will be 1 plus 0.05 raised to negative N, which is negative 50. Can somebody give me this answer? Can somebody give me this answer? So I'm getting PV, first of all, for discounting the lump sum, for discounting that lump sum redemption amount. So in my calculator, I will say 1.05 raised to negative 50. Raised to negative 50. What figure are we able to get there, ladies and gentlemen? What figure are we able to get there? 0.0872. So this is 0.0872. That is PVF. How about PVFA? How about PVFA? To get PVFA, ladies and gentlemen, I normally cram the PVFA formula very, very easily. PVFA is present value interest factor of an annuity. To get this PVFA, what we shall do is to take 1 minus this smaller formula. So 1 minus 1 plus R raised to negative N. And then I divide everything by R. I divide everything by R. So then in that case, ladies and gentlemen, this one here will be 1 minus 1 plus 0.05 raised to negative 50. I divide everything by R again, which is 0.05. I divide everything by R, which is 0.05. So here you have to be very, very careful with your calculator. You will say 1 minus 1.05 raised to negative 50 equals whatever answer you get, you divide it by 0.05, and then you give me an answer as your PVFA. Give me an answer as your PVFA. Somebody already has gotten this. It is 18. It is 18. No, it cannot be 2 decimal places, Esther. Remember, there is always tradition for a subject. PVFA, PVFs, those are always 4 decimal places. Always. Always. 18.2559. Just check again. So this one I'm being told it is 18.2559, like that. Can somebody else confirm that figure? Yes, somebody has been able to confirm it. Thank you so much. 18.2559. Thank you so much. Thank you so much. Thank you so much. And then, ladies and gentlemen, please listen and listen to me very well. Already we have that. So please come back here and give me, this will be 60 times this 18.2559 plus 1,000 times PV, which is 0.0872, which will end up giving me what figure at the end of the day? Was that gentleman called Joshua correct? Was that gentleman called Joshua correct? Was he correct? 1182.56. So I'm being given a figure of 1182.56 like that. 1182.56. 1182.56. So, and once you watch this video, I want to believe you'll become so good at this. Before we meet in our tomorrow's class, I would humbly urge everybody to watch this video. It will be really, really a game changer. Because at first, when you're taught this, you may think you're not understanding, but when you watch this video and then we do a recap tomorrow, then everything will be just fine. Just fine. Everything will be just fine. Yeah, Summit Limited. So we have been able to answer Roman 1, which wanted us to give them the current price of their bond, Thank you very much. And then look at number 2. Was right. Great. Thank you so much. So number 2, ladies and gentlemen, of this question, they want us to give them number 2. Where has it gone to? Will I be able to get it now? And I have another class coming up. The second part was about what here? Yeah. The yield to maturity. Yes, I love yield to maturity. Yield to maturity. So yield to maturity, you need really to be very, very careful. Many students are not able to get this yield to maturity. Yield to maturity. How do we get yield to maturity? So to get this yield to maturity, YTM for a redeemable bond, the yield to maturity for this bond, yield to maturity for this bond, it's very easy. You simply give us the annual coupon. Annual coupon. Annual coupon. Annual coupon. And then remember now, anytime you hear the word yield, there must be market price per share down. Now you can call this one here market price per bond. Per bond. Per bond. But now remember that this has to be intrinsic value. Intrinsic value. Please remember, even if they tell you that this bond is paying semi-annually for yield to maturity, we always work with the annual coupon. The annual coupon. How do we get this annual coupon? You take the coupon rate times par value, times par value, times par value. So this coupon rate is 12%. Our par value is 1,000. 12% for a whole year, remember, this is an annual coupon. So 12% times 1,000, that gives me 120. So then I'll be able to come here and take 120 all over the current value. The formula, the one that you have obtained using a formula, the one that you guys were able to give me as 11 something, 1182, yeah. Was it 1182.56? Was it 1182.56? Yield to maturity. Was it 1182.56 or thereabout? Or thereabout, 1182.56. Yeah, thank you so much. Thank you so much. Thank you so much. Times 100, of course. Times now 100. So yield to maturity for a redeemable bond. Yield to maturity for a redeemable bond. So then this one here will end up giving me what percentage, my good students? 10.14. So this is 10.14, which is pretty close to the current interest rate per annum, which had gone down to 10%. It's slightly more. So the yield to maturity is slightly more. Great. And then, ladies and gentlemen, round off, okay. Round off is okay. 10.15. 15 is okay, yeah. 15 is okay. Thank you so much. 10.15. That's okay. Thank you so much. And then now, ladies and gentlemen, the last question. I don't have the question with me here. What was the last question asking about? My next class has begun. Yeah, the capital gain on the bond. That is really easy. The capital gain on the bond is the profitability index. It is the profitability index. So the capital gain on the bond, I'm looking at my current value, capital gain on the bond. I'm looking at my current value, which is 1182.56. And remember, 5 years ago, I paid how much for this bond? 5 years ago, I paid 1,000. 5 years ago, I paid 1,000. Thanks, Queen. 5 years ago, if you remember very well the question, 5 years ago, I paid 1,000. After 5 years, this bond is worth this much. So I'm able to see the capital gain. I'm able to see my profitability index, which is 182.56, like that. So this is really a super efficient bond. It is an undervalued bond. I would recommend the investor to buy it. Or if he still has it, please remain with it. Don't sell it. Don't sell it. So the investor should be able to buy this or stay with it. So it's undervalued. Yeah, it's a big dog, but which is really undervalued. Yeah, it is super efficient. Investors should be able to buy or hold on to them. So, ladies and gentlemen, that is it for today. See you tomorrow at exactly 2 p.m. Now, tomorrow, what is my plan for tomorrow? Great plan. So tomorrow I'll be able to value the last security. The last security will be, in this case here, preference shares. And the moment you've understood this, then that will be very good. But before I start valuation of preference shares, I have to take you through a convertible bond. Very, very important. I'll be able to do a past paper question, convertible bond. And then number two, I will be able to take you through, ladies and gentlemen, what we call preference share valuation. After that, now we look at the exceptional cases. So exceptional cases in terms of security valuation, we are looking at number one, valuation of rights issues. And then number two, we are looking at, in this case here, the Walters model for valuing an ordinary share. Yeah. And then, of course, we'll be able to see some other small, funny things. And then we say the topic is over. But it can only become nice if you guys can get time and if possible, they watch today's today's session. So again, I repeat, what is the time for tomorrow's class? Our tomorrow's class will be at exactly 2 p.m. and it's mandatory for every student. It's mandatory for every student. No. Yeah, sorry, Doris, it's a timetabled class. It is a timetabled class. We cannot, normally once a class has begun and it's timetabled, if I start making changes, you'll be surprised so many people will not be happy. So many people won't be happy. And I will also not be free at that time. I would have really wished. Thank you so much, Daniel. Yeah. David Amin. Thank you so much. Great. So, ng'ang'aneni kabisa. We should be able to get, remember, every year, every semester, whenever I teach this paper FM, I always get the best student. That is me. The best student normally comes from my class. Yeah, because of this revision. Yeah, so we shall overcome. And of course, if there are students who would want to still join RCM, yeah, we are a big college. Yeah, best college in terms of quality in East Africa. Don't, in this case here, state. Please bring me students. I'm so sure you guys, you can bring me students. My special revision class, for those students who attempted this paper and failed last semester, that class should be huge. So please bring me those students. Bring me those students. Thank you so much. Bye. All right, bye. See you.